Hello everybody, welcome into the NinjaTrader Ecosystem webinar room. Before we get started with today's presentation, I would like to take a moment and test for picture and sound. So if you can hear my voice and if you can see the Kase presentation on screen, please enter Y into the room, and that'll confirm that you can hear my voice and you can see the presentation. Alright, looks like I'm getting some confirmations. Thank you for confirming that for me. Sounds like I'm coming in loud and clear. Thank you all for joining the event today. My name is Ryan Lai. I work at the NinjaTrader Business Development Team here in our Denver, Colorado office, and we have a very special event for you today with Cynthia A and Dean Rogers of Kase and Company. Before we move any forward, I am going to put a quick poll into the room, and that's going to get a gauge of the type of user in today's attendance. And the question is, are you currently using NinjaTrader? This will also allow me to go over a quick disclosure that I have on screen now as well. So I'd like to mention to everybody into the room while they're filling out this poll that it is important to understand that there are substantial risks in trading commodity futures contracts. And you should carefully consider whether these trading is going to be suitable for you, and this will depend on your specific circumstances or financial resources. It is possible to lose all of the funds that you deposit with your broker, and you can even incur losses beyond these amounts. If you have questions, you can always inquire further to the risk disclosure that I posted into the room for more information. That is the CFTC full risk disclosure there. Also, please remember that these training webinars are not a solicitation or a recommendation for any services, but simply educational in nature. And this presentation is being presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. If you have NinjaTrader brokerage-related questions, you should direct them to the NinjaTrader brokerage directly at brokeragesales@ninjatrader.com. There's also a phone number, which is 312-262-1289. Alright, looks like most people had a chance to fill out the poll. In the lead today, we have lifetime license key users, so it's great to see people that are committed to the NinjaTrader platform, also interested in the services that our third-party vendors provide. For those of you who are in the room, if you haven't downloaded NinjaTrader, you can get started for free. I'm posting a link into the room where you can download a free copy of NinjaTrader and get started today. Otherwise, if you're looking to purchase or lease a live license key to trade live within NinjaTrader, I'm also posting the purchase link so you can take a look at our purchase and lease options. Alright, so with that being said, we are very excited for this unique event today, in which Cynthia A and Dean Rogers will explain how Kase StatWare's unique adaptive indicator algorithms will improve the accuracy and timing of trade signals and setups. They will also demonstrate 3 simple steps necessary to enter, monitor, and exit trades using the Kase StatWare. And finally, as a bonus, I'll just show you how StatWare signals can be incorporated into your own trading indicators and strategies using the NinjaTrader platform. So again, thank you for your attendance today. Without any sort of further ado, it is my pleasure to welcome into the NinjaTrader webinar room Cynthia A and Dean Rogers. Go ahead and take it away, Cynthia and Dean.
Well, hello. Are we on the second slide? My slides aren't moving. There we go. Well, great. I wanted to take the introduction to introduce you to Dean Rogers, who is our Senior Consulting Technical Analyst. Dean's background is in computer programming and business, and we've been working together for over 17 years. It's most likely that it would be with Dean or his right-hand man Daniel that you'd be speaking if you have any questions, etc. I'm Cynthia A, president of Kase and Company now for over 25 years. I have a background as a chemical engineer and oil trader with a major oil company prior to getting involved with technical analysis. As for the webinar, the important thing is that we're going to be talking about Kase StatWare, not only how to use it, but why it works as it does. Of importance is that each indicator is really a super indicator, embedding many different calculations into easy to read, simple, often color-coded signals. Kase indicators adjust for variables such as cycle length, volatility, pattern structure, and employs statistical probabilities in identifying such signals. That's my engineering and hands-on experience coming through.
All right, I guess that's my cue. Good afternoon, everyone. As Cynthia said, my name is Dean Rogers, and I know a lot of us have already spoken, and we'll be discussing things going forward in the future here if you decide to take a trial or subscribe to the Kase StatWare indicators. But in today's webinar, what we're going to do is review, like Cynthia said, the Kase StatWare indicators, not only how to use them and what they're showing us on the screen, but why they work in the way that they do. And we're going to do so, first off, we're going to go through the 3 steps of trading. So we're going to look at how the Kase StatWare indicators help us enter or get into trades. In the second section, we'll talk about how we can monitor the trade and manage risk of the trade using stops. These are going to be dynamic stops that adjust with market volatility. And then the third phase is getting out of a trade. And it's often overlooked by many traders. A lot of people spend time really focusing on getting in or where to take, where maybe a profit target might be. But with Kase StatWare, what we look at is we get into the trade, we monitor it to make sure that it doesn't turn against us in a statistically significant manner. And then one of the most important things is getting out. So Cynthia always talks about trades are like relationships. They're easy to get into, but sometimes they're hard to get out of. And so we'll spend a good amount of time talking about how the Kase StatWare indicators can help us get out of trades in a timely and effective manner. In section 5, we'll look at a couple of trade examples using some of the core guidelines. I don't even really want to call them rules, but guidelines that we teach users or traders on how to use the Kase StatWare indicators. Now, these guidelines, and I again emphasize the word guidelines, aren't the only way that Kase StatWare indicators and signals can be used. A lot of the traders that we work with will incorporate the Kase StatWare indicators into their own trading indicators or trading strategies or trading styles. So what we're going to show is really just a starting point for using the Kase StatWare indicators. And on that point, the last section that we'll look at, I'm going to discuss something fairly new that we've begun doing with the Kase StatWare indicators on NinjaTrader, and that is we share the public data members, or basically the signals and underlying information for each of the indicators, so that traders can call those public data members in their own strategies or their own indicators and backtest them. So that's something that we incorporated a few years ago, but we've continued to improve most recently in our latest release, version 991 of the Kase StatWare, which came out about a month ago. So we'll go through a couple of examples of that. We won't spend a lot of time, but I'm going to show a basic strategy that I built, real simple, but show how you can call those public data members and use those in a strategy or in an indicator of your own. So with that said, here is Kase's standard disclaimer. So if you want to take a second just to read through it, it's a standard CFTC disclaimer. We all know that there's risk in trading, so that we need to be careful. And that's one of the things that we're going to be looking at is managing risk and managing trades. All right. So the first section, getting in using the Kase Easy Entry System, or KEES for short. This is one of the 4 core indicators in the Kase StatWare package. KEES, or the Kase Easy Entry System math, looks at a couple of different things. As Cynthia alluded to a little bit earlier, the Kase StatWare indicators aren't just indicators, they're really super indicators, as she said. And the reason that we call them super indicators is because they look at a lot of different information and distill all of that information down into very simple color-coded signals on the chart that are easy to see, easy to use, and easy to make decisions with. So the Kase Easy Entry System uses a combination of a synthetic longer bar length filter, the status of 3 different momentum indicators, whether or not those momentum indicators are permissioned long or permissioned short. So for instance, if I'm looking at an RSI against its own 13-period average. If the RSI is above the average, we consider that to be permission long. If the RSI is below the average, we consider that to be permission short. And then the indicator will decide or look at the 3 different momentum indicators that we're using to see where the majority of those 3, whether for each bar, is permission long or permission short. In addition to that, we also look at, or the Kase Easy Entry System looks at, the direction of the bar close, whether or not the bar is closing up, closing down, making new highs, making new lows. So bar structure is a big part of this. And then finally, swing structure. So we have an indicator that's called Kase Swing that's built in to Keys that looks at whether or not swing highs and swing lows are being held, whether those are being broken, and that will also help to decide whether or not an entry signal is triggered. So as I said a moment ago, the Kase Easy Entry System color codes all of this information into very simple signals on the chart. Now the most important entry signals that we'll see are short and long signals. These are the entry signals for short or long trades. And those are going to be represented by S's or L's that are color-coded based upon their criteria and their strength. And I'll explain more about the strength and criteria as we walk through subsequent slides. But just to kind of give you a primer here, the first signal that appears in the potential change of direction or potential change of trend are going to be warning short or warning long signals, which are going to be kind of a gold or orangish gold colored S and then a green L for long trades. Now beyond that, as the trend begins to develop, you will also begin to see other color-coded L's and S's, either pink or blue S's or L's. So a pink S or a blue L would be what we call a first-class filtered signal. What this means, and again we'll expand upon this as we move along, but what a first-class signal means is that not only are the underlying permissions, let's say, long, but also the longer bar length filter that the indicator is looking at in the background is also permissioned long. So that would give us a filtered signal, which generally is a stronger signal. That's the reason we call it first class. Whereas a signal that is unfiltered, i.e. the majority of momentum is, let's say, short, but the longer time frame filter is still long, would be a second class or a slightly weaker signal. And that's going to be color-coded with a red S. A second class long signal would be a lighter blue or a cyan-colored L. In addition to the L and S signals that trigger entries on the chart, we also color-code each bar with a dot. Now the dot tells us the underlying permissions and whether or not those are first-class long, first-class short, second-class long, or second-class short, in addition to the size of the dot, which is either going to be a large dot, which tells us the bar direction, so the bar structure is in the direction of momentum. So, i.e. if we have a long permissioned bar, if momentum is long on that bar, and the bar closes up and makes a new high relative to the prior bar, then it's going to receive a large blue dot. Now, generally speaking, that's going to tell us that we could take an entry on that bar, and that will qualify for an L signal. If the dot is small, that tells us that the bar structure is closing or moving against the direction of the underlying momentum. So we don't necessarily, in those situations, want to take an entry on that bar. So here's the Kase Easy Entry System in action. So as we can see here, we have a daily crude oil continuation chart, WTI continuation chart. Each bar has a color-coded dot. The large dots indicate the underlying longer bar length filter, which by default is 3 times the size of the bar that we're looking at. So in this case, a 3-day bar would be permissioned in the same direction as the underlying momentum. Those are going to be either the pink bars for short or the darker blue for long. We also can see the L and S signals For instance, in the upper left, the warning short, kind of that orange S, as we have a transitioning move down. And then that is followed by a move down, a small pullback to the upside that holds the prior swing high. So this is where the swings come in. And then a first-class short signal, the pink S. That, under the core guidelines of Kase StatWare, would be the entry point for a short trade. Now, at the bottom of the chart, we can see a green L. That's going to be a long warning signal. The pullback that takes place several bars after that holds the prior swing low, and as the move up begins to take place again, we get a first-class long signal, the darker blue L. That would trigger a long trade. And then this cycles again into a short warning, the pullback to the upside, where the move up holds the prior swing high, and then we get a first-class short signal, where a short trade would be taken.
All right, so filtering trades. When I was first purely trading technically, I always thought it was a good idea to make sure that whatever trade I was going to take in whatever time frame, which was time frames back then, that some higher time frame was saying the same thing. So if one is looking at a 5-minute chart, one might also check a 15-minute chart. But during the first Gulf War, energy got a lot more volatile, and I would get a signal on the 5-minute chart. It would drive me crazy to have to wait sometimes 10 minutes to get a confirmation on the 15-minute. So what I came up with as a solution to higher time frame filtering is to have a moving window. So for example, normally you'd get, if you're going to look at minutes, it would be minutes 1 through 5, minutes 6 through 10, and then minutes 11 through 15. But what the Kase approach does is any higher time frame ends at the same moment the bar that you're monitoring ends. So if you have a 5-minute bar end this 5 minutes, this point right now, it would be 15 minutes back from that point. That would be the 15-minute bar. So it's essentially a rolling 15-minute window that updates every minute. So that way, on average, you'll get your filter happening half the time wait. So you cut your wait on average by half. So that's what's embedded in the filter that we use within the KEES.
So as Cynthia just stated, that rolling synthetic longer bar length, like I said earlier, which is by default 3 times higher than the bar length that is being traded on the chart or being looked at on the monitored on the chart, is built into the Kase Easy Entry system. However, in the Kase StatWare package, we also include what one might call background indicators, such as this longer time frame filter that we call the permission filter or the permission stochastic. And we provide those on a standalone basis for traders that want to look at those and incorporate those ideas into their own trading system or onto their charts. So a trader that's using StatWare does not necessarily have to look at the permission filter or the permission stochastic as we show here. They could just look at KEES. But if they don't look at KEES and they want to use the idea of that longer time frame filter, that longer bar length filter, they could apply either the permission filter, which is the indicator in the middle of the screen that shows the blue and pink colors on for each bar, or the permission stochastic, which is basically a stochastic that uses the underlying rolling synthetic time frame. So those are these indicators here, and so the permission filter, which is shown again in the middle, is going to be permission long, meaning that that bar length, that synthetic longer bar length, is going to be permissioned long when it's blue, and when it's pink, it's permission short. The same can be said about the permission stochastic, where we call it the perm K and the perm D line. So the perm K is the faster moving line, which is in kind of the purple color, and the perm D line is black. So when the perm K is below the perm D, it's permission short, and vice versa for long. Now we've already talked a little bit about the large and small dots, but here are some fairly clear examples of how that works. So we can see the large dots close in the direction of the permissions, and they also make either a new low in relation to the prior bar or a new high in relation to the prior bar for long trades or for long permissions. So what we're looking for here is not only the underlying permissions of each bar's momentum, and that longer time frame filter, but whether or not the bar is actually moving in the direction of the potential trade. Whereas the small dots over on the right, we can see close against the direction of the permission. Generally, you're going to see those forming in some sort of range-bound trading, where we might not want to take a trade because the market's trying to decide whether or not it's going to break higher or break lower. Now, this is an interesting phenomenon that I want to take a few minutes to discuss, just because it's a question that we get quite often, and that is the KEES indicator. When we're using the core guidelines that we talked about, or we're going to be talking about throughout this webinar, is not used for stop and reverse, or SAR. So basically, for instance, on this chart here, we get the long warning, the green long warning signal. We have the pullback that holds the prior swing low, and then we get a first-class long trade triggered by the blue L. So at that point, the trader would enter a long trade. However, we get a correction to the downside, and during that correction, we see a short warning and then a first-class short signal. However, we do not at that point stop and reverse to a short trade. We don't exit the long, and we don't enter a short. The reason being is that we actually use the DevStops, which we're going to discuss in the next section, which are basically trailing stop levels, and or the case momentum signals such as divergence or overbought, oversold signals to actually trigger the exits. So once we get into a trade, once a trader enters a trade, in this case a long trade, they will not get short until they've exited the long trade either by a triggered signal such as a momentum divergence or a stop hit. At that point, once the trader has had some sort of warning that the move up may be over, then they can look at entering a short trade. So with that said, now we're going to start looking at the Kase DevStops, which we use to monitor trades and manage risk.
Okay, there goes my microphone. There are a few things that are important to know about Kase DevStops. One is that they adjust automatically or dynamically for volatility. The higher the volatility, the more the market moves around. And so the larger a move has to be statistically significant. Or if you have a very quiet market that's not doing very much, a small move could be statistically significant. So if you're using stops that are based on the significance of the size of a move, you've got to scale that for volatility. So that's one thing that Kase DevStops do, using true range, which is kind of a linear measure of volatility, directly proportional to volatility over short periods of time. We use a statistically significant or probabilistic approach. So what that means is, relative to everything else being relative to volatility, how big is the move relative to volatility? And volatility is one standard deviation. So without getting into too much detail on statistics at this point, because volatility is a one standard deviation measure, you can use various excursions against a trade of one standard deviation, 2, 3, etc. And it has to know whether or not one is long or short. Because if you're short, the stop's going to go above the market, and if you're long, below the market. So we have a moving average front end on the DevStops that flip it from long to short on that basis. Back to you, Dean.
All right, so here are the Kase DevStops in action. So the Kase DevStops plot on the chart as a solid line for the warning line, and then 3 stops. The Dev1, which is a 1 standard deviation move of the 30-bar average true range. Dev2, which is a 2.2 standard deviation move of the average true range. And Dev3, which is a 3.6 standard deviation of the average true range. Now, one might ask, why not just use 1, 2, and 3 standard deviations? The reason being is there's a right-hand skew to the bell curve for the distribution of volatility. Because prices are bound by 0 on the left-hand side of the curve and infinitely bound on the right-hand side, just about all curves except for maybe spreads, some spreads, have an inherent right-hand skew. And therefore, to adjust for the skew, we use multiples of basically a 10% correction at each standard deviation. So we have 1 standard deviation, and then 2.2 would be a 10% adjustment, and then 3.6 would be a 20% adjustment. Now with the stops, one of the things that Ms. Kase mentioned was that not only do the stops adjust for the volatility, as we can see when volatility increases, the stops will widen. When volatility decreases, the stops will become tighter or more narrow, so that upon a breakout move, if it's against the position, the trade will be stopped out. Whereas when the market's trending and volatility is higher, we have a wider stop to give the trade a little bit more play, and we don't get whipsawed generally as often. Now, in addition to that, we have 2 moving averages. The default for the moving averages on the chart here are 10 and 21, which is the defaults that the Kase DevStop indicator uses. Now this is built in, you don't have to plot this on the chart, but when the 10 and 21 period moving averages cross over, and it's just a simple moving average, at that point, that's when the stops will flip. Now, this is an important point. If the stops are not in the right direction, for instance, in the upper left, we can see that there was a short warning signal, the orange warning, and then a pullback, and then a second class short signal, the red S. Now at that point, the stops are still below the market. That does not mean that we should not take the short trade. All that means is that the 10 and 21 period moving average have not crossed yet. So in this situation, there's basically 2 options. The first option would be to get in and adjust the look-back lengths of the moving averages. So instead of 10 and 21, we might use something that's a little faster, like a 5-period and 8-period moving average crossover. Generally, in my experience, if 10 and 21 isn't working, 5 and 8 will. However, even then, if 5 and 8 isn't adjusting it or flipping the stops in time, or if we don't want to change the settings, we can also place a stop at the prior swing high that came before the warning signal until the time that the stops do flip, at which point we would generally place a stop at Dev3 and then trail that as the market moves down. Now, one of the things that we can also look at, exactly as Cynthia just said, either way, I'm going to step back, we would take that short trade. We would not wait for the stops to flip to enter that trade. Now, one of the things that we can use the stops, there's multiple stop levels, and some people will ask, well, maybe why is there multiple stop levels? And that's because in different situations, dependent upon how the market's trending, whether we're trading with the trend or maybe against the trend, or whether or not we've had some sort of warning signal, we can use tighter stop levels or wider stop levels. So generally speaking, with the guidelines that we teach with Kase StatWare, if the market is trending and we're trading with the trend, so in this case we have a fairly good upward trend leading into this chart, we would place a trade or a stop at Dev3 when we're long. However, if the market is correcting, during that correction, what we determine to be a correction ourselves as a trader, we might use a tighter stop like Dev 2 or Dev 1 to take a little less risk. So it's just a way for us to manage the trade risk based upon the trend. All right, so now that we've gone over getting into a trade using keys and monitoring the trade using multiple levels of stops with Kase DevStops, we're going to talk about what we consider to be probably the most important aspect of trading, and that is deciding when to get out of a trade. And we do this using momentum indicators called the Kase Peak Oscillator, or Kase PO, and the Kase CD.
Okay. So one of the first things I'd like to say is that the Kase momentum indicators also adjust for volatility. I can't stress enough that everything more or less has to be scaled for volatility, because you want to take risks that are proportionate to what's necessary but no more to make money, and you don't want to be stopped out of trends prematurely. So it's very important for everything to be scaled for volatility. So our momentum indicators, as you'll see soon, adjust for volatility. As a measure of trend, we use an index. So when I say measure of trend, like moving averages, for example, would be considered a measure of trend. For a measure of trend, we use an index that measures the statistical significance of a move up or move down, and that's all based on its magnitude relative to volatility. So volatility is one standard deviation, and the mean is the starting point, and so one standard deviation move is not that significant, but if the market moves 2, 3, 4, etc., standard deviations, that becomes more significant. So this index that we have developed is a measure of trendiness. The farther away relative to volatility the market moves away from the mean, the higher the odds are of it being trendy rather than noise or random. Okay, let's go to the next slide. I'm going to start in the middle here with the red, because I don't want to get bogged down in the calculations. So what we do is we look at how many standard deviations the market has moved up or down relative to volatility, which by definition is one standard deviation. So the formula is there. You can look at it if you're an options guy or a numbers person, as I am. But if you don't want to bother, basically what it's doing is it's looking how much the market's moved up or down relative to volatility over a certain range of periods optimized by cycle length. So that means, for example, you might say, well, up or down over how many bars? And that is, I would say yes. So we look at a range of bars. So we might look back 8 bars, 9 bars, 10 bars, 11 bars, all the way to maybe 89 bars. And whichever cycle length gives the most significant move, the indicator uses that period. So make a long story short, the Kase indicators use measures of trend, which are based on all these things I just explained, and uses these measures of trend exactly the same way that moving average oscillators and second derivative moving average oscillators like the MACD do, but instead of using moving averages, we use this relatively sophisticated measure of trend. So the next question might be, so what? So the important so what here is, and I just have to check on what's the next slide. Okay. So Dean's going to show you some signals. The bottom line is that case indicators, the stochastic, MACD, all these different indicators, once they trigger, usually have pretty good follow-through. But the case indicators catch 80% of the turns, and the traditional indicators often catch half that. So if you're looking for something to warn you that there will be a turn, the case indicators work twice as well as traditional indicators. If you're monitoring 1,000 different screens and looking for a signal, then they work about the same. And I published a lot on this, so I won't talk any further, but if anybody wants to see all the statistical and data backup, I published a lot on this topic. Back to you, Dean.
All right, thank you, Cynthia. So here at the bottom of this chart, we see the Kase PO, which is the top momentum indicator or top histogram, and the KCD, which is on the bottom. So the momentum values are plotted as a histogram. We just had somebody ask that question. And something that we didn't talk about on the last slide, that was shown on the last slide, but the Kase PO is looking at the rate of change of price. So rate of change of the underlying price. Whereas the KCD is what would be considered a second derivative momentum indicator, meaning it looks at the rate of change of the Kase PO. So it's a rate of change indicator, kind of like the MACD is. So that's the name, KCD. Now, with these momentum indicators, we look for signals. We look for momentum divergence, which are shown by color-coded trend lines that are drawn on the chart between peaks and price. So for instance, on the left-hand side of the chart in the upper left, we see a green trend line connecting swing highs. In that case, prices were rising, so the swing highs were rising, while momentum was declining on the Kase peak oscillator, the Kase PO. So the Kase PO signals are shown by green signals. On the right-hand side and in the middle of the chart, we see a bullish and then a bearish divergence. So the bullish divergence, which is drawn in red, is measured from the KCD indicator, the very bottom indicator. In this case, prices were falling while momentum was becoming less negative. And on the right, we have rising prices with declining momentum on the KCD. So the divergent signals are the strongest signals that are generated by the Kase PO and KCD. And so one of the important ideas behind this, though, and it's a question that we get often, is the signals are drawn at the swing highs and swing lows. But they require confirmation before they can be drawn. And so in the case of, let's say, a divergence, for instance, on the right-hand side of the chart, this bearish KCD divergence drawn with the red trend line, we have to wait to not only make sure that there's a swing high in price, but also a high in momentum that has been confirmed. Therefore, the confirmation takes place 2 bars after the swing high in price. So you'll never see well, very rarely, very, very rarely, unless it's an outside bar, will we see the confirmation bar take place on the same bar as the swing high or swing low. Generally speaking, it's going to be 1 to 2 bars away. And this is a setting that can be changed within the KCD and Kase PO indicators. So again, just the idea here is that we have to wait for the confirmation of both the swing high or swing low in price and a swing high or swing low in momentum. Now, one of the newest improvements to the Kase StatWare trading indicators, KCD and Kase PO signals, is the idea of strong and weak divergence and or overbought, oversold signals. Now we haven't talked about the overbought or oversold signals yet, but those are shown here on this chart. So you'll notice on the left-hand side of the chart there's a little red K and a green P below a swing low in price. These are called a KCD peak, which is in red, and a peak out, which is in green. And these are generated by the Kase PO and the KCD indicators when they become, in this situation, oversold. So unlike a traditional momentum indicator, let's say like the Stochastic or RSI, which move into oversold territory and can remain there for a very long period of time, there's really no triggered signal, just an overbought or oversold status. With the Kase indicators, we actually can pinpoint areas where or bars upon which a overbought or oversold signal takes place. So in this situation, once the momentum became oversold on the Kase PO and the KCD, and a swing low in price was made, and a swing low in momentum was confirmed, at that point, the confirmation bar, which is the arrow is drawn to, closes up. So that's in the direction of a bullish oversold signal. Therefore, that would be considered a strong signal. Just like the divergences in the middle of the screen, we have the green and the red trend lines being drawn up to a swing high. When the market moves back down, the confirmation bar, in this case, closes down. Therefore, it's closing in the direction of the signal. These are bearish divergences. Therefore, based upon our studies, those are generally speaking stronger signals. Whereas we can see in the middle of the screen here a dashed red trend line, very small, it's only 4 or 5 bars long. But what happens here is we have falling price with rising momentum, or momentum that's becoming less negative. And in that situation, upon the confirmation bar actually closes down. So this is a bullish signal, but the confirmation bar is closing against the direction of the signal. Therefore, we consider that a weak signal. Same with the gray K and the gray Ps. Those are considered to be weak signals. They don't perform as well. Now they can still be treated as a warning, meaning that we can tighten our stop levels. But generally we're not going to take any profit when those signals are shown. Now I talked a lot about guidelines earlier, and we've talked about some of those guidelines of trading, like for instance with the entry signals, whenever we see a warning signal, let's say a long warning, the green L, then a pullback that holds a prior swing low, and then a red or a pink L based upon first or second class, we would go ahead and get into the trade. That's a guideline. Somebody asked a little bit earlier, can we enter upon the warning signal? There are certain situations where we might, and if we have time, I'll show an instance of that. With the dev stops, we generally place a stop at dev 3 when we're trading with the trend, maybe dev 2 or dev 1 if we're trading against the trend. And then with the divergence signals, based upon, or the momentum signals, divergence, and the peak out and KCD peaks, the overbought, oversold signals, based upon whether or not they're normal, weak, or combinations thereof, we may take different actions. So these are the guidelines, the recommended guidelines that we teach and use with StatWare. So for instance, if we have a dual divergence, meaning there's a divergence, both a normal Kase PO and KCD divergence, just like we saw on the last chart. I'm going to flip back to it for just 1 second. Up at the very top of the move, in the middle of the chart, we have the red and green divergence lines. That's a very strong indication, again according to the studies that we've published, that show that there's going to be a statistically significant turn to the downside. It's telling us that that move up is exhausted, that we should take any profit out of a long trade and go ahead and get out. So at that point, upon a dual divergence, we recommend getting out of the entire trade. If there's a single divergence, just a red trend line or a green trend line, then we would go ahead and just exit 80% of the trade and place a stop at dev 1. If dev 1 is hit, we'll go ahead and get out. Otherwise, if we get a reversal signal, so this is one of those instances where once we've had some sort of warning, we've taken some profit based upon the momentum exit signals. If we get a confirmed short signal, i.e. a first or second class short signal, before dev 1 is hit, we can actually go ahead and get out of the remaining 20% of the long trade and take that short trade. And so I'm not going to go through all the guidelines here, but the idea is based upon the combinations of signals, or based upon whether or not it's a normal or weak signal, we can take different actions based upon the risk that's associated with that signal or combination thereof. All right, so finally let's go through a couple of trade examples here, and I will try to walk through these fairly quickly so that we can actually look at some of the other stuff that we wanted to go through with the code and the public data members. So here we actually have a crude oil on a 15 range bar chart. Somebody asked earlier if we could use range and tick bar charts. Absolutely can. So we have a long warning, a pullback that holds the prior swing low on the left-hand side of the chart, and a confirmed first-class long trade. So it's a filtered long trade. So at that point, we're going to go ahead and get long. Because the stops are not flipped in the correct direction yet, we can either accelerate the crossover, the 10 and 21 period moving averages by changing those to 5 and 8, or we can place a stop at the prior swing low until the stops flip, and at that point place a stop at Dev 3. Now a few bars after the first class long entry, we actually get a KCD peak, but it's weak, it's gray, meaning that the confirmation bar closed against the direction of the signal. The confirmation bar in this case closed up. Therefore, in this situation, we're going to just tighten our stop to Dev 2. We're not going to take any profit or get out of the trade. We're just going to treat it as a warning and take a little less risk by tightening our stop. Now, a few bars later, and I should have marked this on the chart, but a few bars later, we get a new high and another first-class long signal. At that point, we can go ahead and widen our stop back out to Dev 3. Because a new high has been made, that KCD peak is no longer valid. So now that signal's been wiped out, and we can go ahead and increase our risk by widening the stop to Dev 3. The move up trends, we actually end up getting a KCD divergence and peak out. Now based upon our guidelines, that would be an 80% exit. So that's the red trend line and the green P. So at that point on the confirmation bar, which is about 1 bar later after the swing high, we would go ahead and take 80% of the profit out of the long trade and place a stop at Dev 1. 1 bar later, Dev 1 is hit, and so the remaining 20% of the trade is exited, and at that point we get a short warning signal. Now I'll come back to this in a minute. That's a potential entry point for more aggressive traders. Somebody asked that question a little bit earlier. But under the core guidelines that we teach, we would wait for a pullback to the upside that holds a prior swing high, and then as the move down continues, we'll go ahead and enter a short trade on the first class short signal. At that point, we'll place a stop at Dev 3 if Dev 3 is flipped in the right direction. Otherwise, we'll place it at the prior swing high until the stops flip or we force them to flip. Again, a few bars later, we get a weak KCD peak, so we tighten our stop level. But then 2 bars after that, the market makes a new low, so we can go ahead and that KCD signal is no longer valid. No, it's been wiped out, and we can go ahead and widen our stops back out to Dev 3. Okay, so we're assuming that we would have stayed short at this point moving forward. Now, to take a step back, someone asked a question a little bit earlier about entering upon the short warning signals. In one of our other systems called Kase X, excuse me, which is basically just a derivative of the Kase StatWare signals. Kase X just shows the signals on the screen in a very simplified manner using color-coded symbols. But in that, one of the signals that we have is what we call a Pierce dart. And it's basically the combination of for instance, in this case, bearish divergence and short warning signal that occur within 2 bars of one another. And that's the case here. And in those situations, aggressive traders can take that trade. So this would be an instance that's kind of outside of the core guidelines of StatWare, but where someone might choose, like especially if they're kind of a scalping type trader, they may choose to go ahead and enter a short trade earlier. Okay. And then the final chart that I have here is a gold daily chart showing on the left-hand side, again, very simple, long warning. We get a pullback that holds the prior swing low, and then we get a first-class long signal where we can enter the trade. The market continues to move up. Upon the bearish KCD divergence, we go ahead and exit 80% of the trade. Actually, in this case, the bearish KCD divergence is the confirmation bar. So the bar where we would have seen that KCD divergence drawn is actually a bar that hits Dev 1 at the same time. So in this instance, rather than exiting 80% and then pulling our stop into Dev 1, because Dev 1 has already been hit, we'll just exit the entire trade all at once. Now we also get a short warning on that confirmation bar. So this is another instance where a more aggressive trader could take that short entry signal. Now as the move down continues to decline, or as prices continue to decline, we get a pullback that holds the prior swing high, and then we get a short second-class signal where a more conservative trader could take the short entry, and from that point, as prices continue to move down, we see we have a little pop, we have a long warning, the green L kind of right in the middle of the chart, but Dev 1 holds. In fact, Dev 3 holds, which is where our stop is. We haven't had any warnings or exit signals at this point, so we just continue to ride that trend down until we get the bullish KCD divergence where we exit 80%, we get a long warning, and then the market moves up, hits Dev 1. Now I don't have it marked here, but we get a little pullback and then a second class long signal. It's the light blue L that's right on the warning line, the red L, or the red line. And at that point, we would go ahead and get into a long trade.
Thanks, Dean. Why don't you skip to the final slide and put yourself on pause and go get a drink of water, and I will say what I was going to say at this point. So I do want to thank everybody for coming. Dean has a lot more to show you, but I would like to say that I know that a computer has finally beat a human being in the game of Go, which has more solutions than there are atoms in the universe. Nevertheless, there is no computer that by itself can consistently beat human beings aided by computers. We know this because no organization has yet taken over the world. So I think the best combination for trading, and this is what we've built our indicators on, is for human ingenuity, human intuition, human observation of patterns to be combined with algorithms that can do what computers do best, and that's do a lot of calculations and condense a lot of information into a simplified format that's easy to interpret but gives you a lot of info. Dean, are you back?
Yes, ma'am, I am. I think my voice sounds better now too.
So thank you, everybody, and on to Dean.
All right, so before I get into the public data members, and we're probably going to run out of time here, but I will show at least one example. If you have questions about the public data members, feel free to call or email me, contact us, and we can go through that even more. But nonetheless, so for this webinar, we're giving a special offer. Anyone that signs up for a trial will get a 30-day trial. That's standard. But we're offering a 13-month subscription at a rate of $18.95. That's a 25% discount over our monthly rate, which is $195 per month. So if you are interested in signing up for a trial, please click on the link or copy down the link, the casco.com/Kase StatWare Technical Indicators. You can actually, I'm told at least, you can actually click on the link right now and it should take you to that web page. So you can bookmark it, make it one of your favorite places. We have lots of videos, lots of information, a lot of great stuff on the website, educational materials, lessons. One of the things that we also do is, I had a gentleman yesterday, hopefully he's on the webinar, We talked about the white glove treatment. So one of the things that we like to do is we really try to work hands-on with all of the traders that we work with, private traders, institutional traders, whomever it may be. And so we also offer with the trial, with the 30-day trial, 2 lessons, one-on-one lessons they're going to be either with myself or my right-hand man, Daniel. And so we'll walk you through the basics and the guidelines of the Kase StatWare indicators, talk a little bit about how you trade, your trading style, what you trade, and we'll try to help you incorporate the indicators into your trading style in the best way that we can. So all of that information is on kasego.com. You can also contact us. You see our phone number on the right side, 505-237-1600, or you can email us, kase@kasego.com. We also have, it's fairly new, video course. It's a 13-part series published by Wiley. It's called Kase on Technical Analysis. Anyone that's interested in learning more about not only Kase StatWare, but our approach in forecasting, using analysis like Fibonacci, retracements, candlestick patterns, geometric formations. It's a great video series, 6.5 hours of tutorial on Kase's approach to technical analysis. And you can get it on Wiley.com, Amazon, or several other sites. So with that said, I'm going to go ahead and share out my screen here. And I wanted to talk for just a moment here. I know we're short on time, but public data members, one of the biggest requests that we've had over the last couple of years as people have moved into trying to at least automate or backtest strategies and trading ideas is whether or not they can use our signals in their strategies. And so I will bring the link back up for the 30-day trial at the very end. So that's the link that you can click on in that last slide. So what we've done is we've exposed all of the public, or made public data members for the signals, the underlying values of, like, for instance, the momentum histograms on the Kase PO, the KCD, the L's and S's, the color-coded dots, the DevStops, the reversal amounts, so on and so forth. And so if anyone asks for or is interested in that, we will send you this little guide that shows you the exact syntax that can be used in NinjaScript to call the Kase public data members. And so I've written up a small strategy that actually will allow us. So this is very simple, okay? I didn't do anything complex or crazy, but I just wanted to show you how simple and easy it is to use NinjaScript. And I have to say, this is a great platform for, you know, I love NinjaTrader 7 and I really love NinjaTrader 8 as far as the development environment. It gives you a lot of flexibility and it's very easy to use. So what we've done here is I have a variable called permission, and I'm calling in the KEES function or the KEES indicator, and I'm looking for the KEES entry signal. Now, I can also call the KEES, what a public data member calls KEES signal. KEES signal will give me the color-coded dot. KEES entry tells me whether or not the bar has an L or an S. And the return that it's going to give me is either going to be a 0, 1, 2, or 3, or negative 1, 2, or 3. Negative values are short, positive values are long. A 1 is a warning line, 2 is second class, 3 is first class. So for instance, if I get a positive 3 returned to my permission variable from this public data member called KEES entry, that means that I have a first class L, the dark blue L on that bar. Very simple. Now with that, I can combine that with other indicators or the Kase StatWare indicators or whatever I want. So for instance, what I have here is I'm just saying that if the permission is greater than 0, meaning it's a long signal, whether it's warning, first class, or second class, and a 5-period simple moving average is greater than the 13-period simple moving average, I'm going to get long. Otherwise, if the permission is less than 0 and the moving averages are, the simple moving average is below, the 5-period moving average is below the 13, then I'm going to get short. Very simple strategy, right? So let's take a look at how it performs. And again, I'm not trying to show, you know, that this is the greatest trading system ever. What I'm trying to show here is just how simple and easy it is to use NinjaScript and Ninja's really great strategy analyzer. So I ran it, this is on The crude oil continuation, I just did a daily chart. Again, I'm keeping things very, very simple here. We can test this on our X range bar as well, a custom bar type that we have in NinjaTrader. It's a little over a 4-year test. And so with that simple indicator, you know, we're looking at a profit factor of about 2, 47% win. So very simple, very easy. But even just that simple, using the Kase StatWare indicators, using just the KEES entry system with a simple moving average gives us, you know, fairly decent results here. So if anyone has questions on this, and I'm going to go ahead and stop sharing my screen now, and I'm going to go ahead and bring the slides back up so that we can actually see the link. So the link here is to the trial offer is kasego.com/Kase StatWare Technical Indicators. It's kind of on the left-hand side of the chart of the slide. If you click on that, that will take you to the Kase StatWare page, and at the bottom of that page you can fill out the form. Be sure to put in, you know, whether you're on NinjaTrader 7 or NinjaTrader 8, and we will send you everything that you need. And when you install it, it will set you up. So with that said, if anybody has any questions, Ryan, do we have a couple minutes for questions here? I see a couple of questions in the, all right. Yes, Michael, it does work with the day trading style. You can use this on just about any bar type, any time frame or bar length, whether that's time, range, X range. I'll talk about the X range here in a minute, and so on and so forth. I just showed the link for the 30-day trial. Cynthia, you might want to answer what your view is on bar types. I can tell you that from my personal experience, range type bars, not just range bars, but range type bars like our X range bars, which are available on NinjaTrader, are preferable. We prefer range type bars, bars that use price movement rather than time or volume. And let's see, Lawrence asked, is the X range bar part of StatWare? Anyone that takes a trial of StatWare and subscribes to StatWare will receive the X range bars as part of the StatWare package. So X range bars basically are a custom bar type that is built into NinjaTrader. And what it does is it's a high-low range bar. So just like a range bar that looks at a target range. Let's say I'm using 10 points. The high-low range of the bar is going to be as close to 10 points as possible. Okay, we're not going to use any fake data. We're not going to use any ghost data. We're not going to fill in gaps. We allow all of that to proceed on the chart. If there's a gap, we're going to see the gap. But what makes the X range bar special, aside from not using any fake data, is that it mimics an underlying time bar's high-low range or average high-low range and adjusts that on a day-to-day basis. So basically, in a very high-level sense, what the X range bar does is you type in the bar length, the time bar length that you're looking to mimic. Let's say you normally trade a 15-minute bar. You would put in 15 minutes, and then what that does is it looks at what the average high-low range is for a 15-minute bar over a given period of time, and uses that as the target range for that day. Then the next day it will reassess what the target range will be for the new day. So each day that target range is going to be adjusting with the volatility. Let's see, what other questions do we have? The signals can be read by Bloodhound in NinjaTrader 7, yes. Yes, we've had people, and that's one of the reasons that we've opened them up and opened up the public data members and allowed that. So that's something that we can work with you on. We've done a little bit of work with other clients on that in the past. Someone asked if there's any particular type of instrument that this works best on. We get a rap because we have, for those of you that are more familiar with Kase and Company, we do a lot of work with energy. We have energy forecasts, crude oil and natural gas, Brent, gasoline, heating oil, or diesel. So a lot of people think that our indicators are optimized or best built for energy commodities. It's not true. The indicators can be used on anything, whether it's foreign exchange, other commodities, equities, fixed income, so on and so forth, any bar length like we talked earlier. Okay. All right, well, if that is it, I think unless Cynthia has anything else that she would like to add, I think we're good.
Okay, so the offer is good for 30 days. I think we're saying that if you take a 30-day trial based on this webinar, it's indefinite from today. But we'll change that if it gets a few months away, and at that point probably we'll cut it off. The indicators work on anything. The key is that you have to trade something that's liquid and actively traded. Otherwise, nothing's going to work on it. So that's the key: is to use to trade things that are liquid and actively traded. The shorter the bar length, the more trouble you'll get yourself into with instruments that are not actively traded and highly volatile. Okay, I'm going to sign off. Thank you, Dean. Thank you, everybody.
Thank you, everyone. We appreciate you coming to the webinar today. We'd like to also thank NinjaTrader for giving us, presenting us with the opportunity. Thank you, Ryan, for everything that you've done for us. And I look forward to talking to all of you. Or as many of you as I can. So again, we're very hands-on. If you have questions, please call, email, and we'll talk to you again very soon.
Alright, this is Ryan from NinjaTrader hopping back on here, and I'd like to give a special thank you to Cynthia Kase and Dean Rogers of Kase and Company for their great presentation today. The NinjaTrader ecosystem is pleased to sponsor these weekly vendor events as a value-added service for all of our clients. So if you find value in these events, we would hope that you would attend them on a regular basis. And we'd like to remind everybody in the room today that the information presented was that of Kase and Company and not that of the NinjaTrader group. All information presented was for educational purposes and should not be construed as trading advice. If you are interested in continuing NinjaTrader training, we do hold these platform training events live every week, and you can check out the schedule at the link I'm posting into the room. Again, we appreciate the time that you spend with us in our webinars. We hope that you enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from everybody here at NinjaTrader.